Forget the movies, forget the CGI. Imagine a disaster so silent in its approach, yet so deafening in its impact, that it doesn't just reduce buildings to rubble, it utterly collapses the financial spine of the United States. We're not discussing if the next big one will strike. Geologists agree that it's inevitable. We are here to talk about the cost. This is the story of the trillion-dollar earthquake. For decades, our media has fixated on the human toll, the sheer scale of the death and injury count, and that is horrific, of course. But the truly devastating, the most unpredictable, and arguably the most dangerous threat is the financial fallout. The debt, the bankruptcy, the crippling economic depression that follows the shaking. It's the hidden consequence no one is truly prepared for. Insurance companies estimate that a major rupture on the San Andreas fault could generate economic losses exceeding $200 billion in the first week alone. Yet, that figure is just the direct damage. It completely fails to account for the systemic ripple effects across our entire globalized economy. We need to look much, much deeper than the surface cracks. The true conservative estimate from top modeling firms, factoring in business interruption, supply chain failure, and infrastructure destruction, pushes the final price tag past the terrifying $1 trillion mark. To put that in perspective, that's more than the GDP of entire countries wiped out in a single, catastrophic event. This ISN. Our first, and perhaps most shocking, economic vulnerability is the sheer lack of earthquake insurance. Across most of the highly exposed regions in the United States, less than 20% of homeowners actually carry specific earthquake coverage. Home insurance typically excludes ground movement, meaning millions of mortgages are ticking time bombs. When the shaking stops, and an unreinforced masonry building is condemned, the homeowner is still on the hook for their mortgage, potentially for a house that no longer exists. This creates a cascade of personal bankruptcies that rapidly destabilize the local, and eventually, the national banking sector. The asset is gone, but the debt remains. Now, scale that personal disaster to a few million homeowners across California, Oregon, and Washington state. The banking sector becomes instantly clogged with defaulted mortgages, triggering a credit freeze. This financial paralysis is far more damaging than the rubble, stopping small businesses from reopening and halting the entire reconstruction effort. The Northridge earthquake in 1994, though only a magnitude 6.7, resulted in nearly $49 billion in insured losses. That event nearly broke several major insurance carriers. A magnitude 7.8, which is 30 times more powerful, would simply overwhelm the current reserves of the entire U.S. insurance industry, forcing massive government intervention. This dependency on a massive government bailout is precisely why the cost balloons past $1 trillion. It's not just the direct damage. It's the cost of the federal government stepping in to become the insurer of last resort, printing money to service the debt bomb we failed to defuse. But that's just residential debt. The supply chain gridlock is an economic killer of a different magnitude. Our second vulnerability lies in the very arteries of our economy, the infrastructure. The financial fallout of a major quake isn't just about destroyed buildings. It's about the paralyzed system of ports, highways, and rail lines that feed the global economy. A severe disruption in California is a supply chain catastrophe for the entire nation. Consider the Port of Los Angeles and Long Beach, which handles over 40% of all containerized cargo entering the United States. Even moderate damage to the piers, container cranes, and local rail lines would shut down this massive logistical hub for months, instantly paralyzing imports of electronics, auto parts, and manufacturing components. The cost of this interruption isn't measured in concrete. It's measured in time. Analysts estimate the daily economic loss from a full shutdown of key infrastructure, including the I-5 corridor and major rail lines, to be well over $1 billion. Every day that supplies don't move, that products aren't manufactured, the financial toll simply mounts. The risk is compounded in major seismic zones like the Pacific Northwest, where the Cascadia subduction zone threatens to wipe out critical pipelines and major energy transmission lines for months. The subsequent energy shortage and gasoline price spikes would impact nearly every household and business in the western United States, far from the epicenter. The immediate cost of fixing a bridge or a freeway is immense, but the true burden is the indirect cost, the economic opportunity lost while the nation waits for the logistics to restart. This paralysis of movement is the second key ingredient in the trillion-dollar calculus, and it leads us directly to the devastating long-term social costs, that truly cripple a society. The third and most insidious economic vulnerability is the long-term impact on people and place. The trillion-dollar figure isn't just equipment and concrete. It's the cost of community breakdown. When housing is destroyed and insurance fails, millions of people instantly become internally displaced refugees within their own country. This mass displacement triggers a catastrophic housing crisis. Rents in surviving undamaged areas would skyrocket, creating an immediate wealth transfer from the poor and middle class to undamaged landlords. The cost of rebuilding goes far beyond the materials. It includes the massive societal subsidy needed to keep displaced families sheltered. For the individual, the earthquake erases decades of financial planning. Savings meant for retirement or college tuition are instantly repurposed for immediate survival. We would see a sharp, rapid spike in poverty rates and an increase in dependence on federal aid programs, locking millions into financial distress for years. This is the ultimate social cost. Studies on past major quakes show that communities take a decade or more to truly recover their economic output and population levels. The destruction leads to a permanent brain drain as skilled workers and businesses, seeking stability, relocate out of the high-risk zone, gutting the local tax base. When you total the cost of a decades-long decline in tax revenue, the ballooning federal debt to finance aid, and the widespread loss of personal wealth, the figure rapidly spirals beyond the trillion-dollar mark. This leads us to the critical question: what are the engineering solutions that the U.S. is employing to stop this financial time bomb? Facing this daunting financial prognosis, the United States is fighting back with cutting-edge engineering. Our engineers are constantly racing against geology, designing structures that are not only stronger, but smarter, capable of absorbing and mitigating the tremendous kinetic energy of a major earthquake event. One of the most effective technologies is base isolation. Instead of anchoring a building directly to the foundation, massive rubber and steel bearings are installed between the structure and the ground. When the ground shakes, the isolators move, allowing the building to float, dramatically reducing the forces transmitted to the structure above. For existing buildings, engineers use viscous dampers, think of giant, hydraulic shock absorbers placed within the structure's frame. These dampers dissipate the earthquake's energy as heat, preventing the steel beams from bending and collapsing. They are an expensive, but vital, intervention for safeguarding historical or essential structures, costing millions per installation. Another critical step is the widespread rollout of early warning systems, particularly the Shake Alert system on the West Coast. This technology detects the first non-damaging P wave and quickly sends an alert before the destructive S wave arrives. That crucial few seconds can be the difference between a minor and a major economic disaster. These engineering feats offer a glimmer of hope, reducing the probability of catastrophic widespread failure that triggers the trillion-dollar cost. But technology can only do so much. The rest falls to individual and community preparedness, which remains our weakest link. The real question is, what can you do to insulate your personal finances from this economic apocalypse? If the government and big business cannot fully insure us against a trillion-dollar disaster, then personal financial preparedness is your ultimate fortress. You need a financial go bag, as much as a physical one, and the first item is simple: paperwork. You must have physical, waterproof copies of your insurance policies, mortgage deeds, and bank account information. Secondly, every homeowner in a high-risk zone must seriously re-evaluate their insurance coverage. Standard home insurance will not cut it. Talk to your agent about the true cost of earthquake riders and understand the deductible, which is often a percentage of the home's value, not a fixed dollar amount. This percentage can wipe out savings instantly. Crucially, keep a liquid emergency fund separate from your savings. Experts recommend keeping enough cash on hand to survive for at least 1 month with zero access to banks or ATMs. This fund bridges the gap between the disaster strike and the arrival of any federal or insurance aid, which can take weeks or even months to process. Furthermore, understand your debt. In the event of a major disaster, creditors may offer forbearance, but interest still accrues. Knowing the terms of your mortgage and loans before a disaster allows you to make rapid, informed decisions, protecting your long-term credit rating from the subsequent financial chaos. Don't wait until the power is out to read the fine print. This personal preparedness is the final line of defense against the trillion-dollar shockwave. It won't stop the ground from shaking, but it will insulate your family from the secondary financial collapse. But before we conclude, we must address the ultimate question. Are we doing enough as a society to avoid this inevitable fiscal nightmare? The ultimate dilemma is a social one. Mitigation is incredibly expensive, but the alternative is far worse. Cities like Los Angeles have mandated the retrofitting of thousands of vulnerable soft-story apartment buildings, recognizing the massive risk they pose to life and economic stability. This is a crucial step, but it is slow and politically challenging. The cost of retrofitting historic bridges, updating old schools, and reinforcing utilities is passed directly to the taxpayer, often leading to public resistance and political delays. Every time a bond measure fails or a budget is cut, the probability of hitting that trillion-dollar price tag slightly increases. We trade short-term savings for catastrophic long-term risk. Furthermore, there is the risk of induced seismicity or man-made earthquakes, particularly in states like Oklahoma, linked to wastewater disposal from fracking. These quakes, while often smaller, represent a new, unpredictable source of financial liability that falls outside traditional geological risk models. The legal and economic fallout here is still being determined. The political will to proactively spend billions today to avoid trillions in the future is always the most difficult sale to make. It requires leaders and voters to think decades ahead, prioritizing abstract future safety over immediate budgetary needs. This foresight is rare, but absolutely essential to securing our national financial integrity. Our failure to fully invest in this structural and financial hardening means that the trillion-dollar disaster remains a looming possibility, threatening to redefine the American economic landscape. The only remaining question is how the U.S. government will respond when the financial tidal wave finally hits. When the shaking stops, the final trillion-dollar bill lands on the desk of the federal government. FEMA, the Federal Emergency Management Agency, is tasked with the immediate response and long-term recovery. But its budget and operational capacity are simply not designed to handle a disaster of this scale in a major urban center. In the immediate aftermath, the president would be forced to sign massive emergency declarations, instantly freeing up tens of billions of dollars. But this is where the politics begin. The disaster funds are often slow to arrive, subject to bureaucratic red tape, and quickly depleted by the sheer scale of the need for temporary housing and essential services. The U.S. Treasury would likely have to issue massive amounts of new debt, or literally print money, to stabilize the financial markets, prevent bank runs, and nationalize the recovery effort. This sudden injection of capital could trigger significant inflationary pressures across the entire U.S. economy, impacting the value of the dollar globally. The political fallout would be immense. States not directly affected would understandably balk at funding a massive bailout for a state like California, raising difficult questions about national solidarity and fiscal responsibility. The debate over who pays and how much would dominate Congress for years, delaying reconstruction and deepening the economic wound. This inevitable debate and the massive debt burden it imposes on the entire nation are the true long-term price of the trillion-dollar disaster. It is a financial reckoning that will touch every single taxpayer in the country, whether they live on a fault line or not. This is why our understanding of risk needs to fundamentally change. So the final calculation is clear. The next great earthquake is not just a geological event. It is a guaranteed financial cataclysm, locked and loaded at over $1 trillion. The cost is built into our lack of insurance, our fragile supply chains, and our chronic underinvestment in structural hardening. The question is no longer if we can prevent it, but when we will be forced to pay the bill. We have the science, the engineering, and the financial models to understand the risk, but our political and personal will to act on that knowledge remains dangerously slow. Until we address the systemic failures in insurance, debt, and infrastructure, we are all exposed to the seismic financial shockwave. The only way to win is through preparation. Take the steps we outlined today. Secure your personal documents, check your insurance, and build that emergency fund. Your financial survival should not depend on the speed of a FEMA response or the politics of Congress. It depends on you. If this deep dive into the true cost of disaster opened your eyes to the financial risks facing the nation, please hit the like button right now. That simple action helps this vital information reach more people who need to prepare for the inevitable. Your support helps us dissect the hidden risks that the mainstream media ignores. And don't stop here. The earthquake is $1 trillion threat, but the financial risk of the next great flood or major hurricane poses an entirely different, equally destructive crisis. Click on the video on your screen right now, where we break down the insurance and debt crisis caused by America's rapidly intensifying weather threats.
See you there.